webinar was because during that recession, I saw so many advisors and their clients in a really bad investment and advisory business situation. And, because of what they didn't do before it began. Now, two of those things were assessing the risk tolerance of each of their clients, then preparing each of those clients for a possible recession, or even just a possible average size correction. I really believe that if they had done that, their clients and themselves wouldn't have gotten into such a bad situation that they did experience. So we're fortunate to have an expert on this topic to help us today. He's an expert in behavioral finance and investing, and that's Jeff Hybeck. He's the Senior Portfolio Manager and Chief Operating Officer of SEM Wealth Management, and recently they celebrated their 20th anniversary. I hear a lot of people coming on board. Just a reminder, we have this videotaped, and everyone on mute. If you have any questions, just type them in, and Jeff can get to them at the end. So, Jeff, if you could start us with this program.
Yeah, thanks a lot, Mike. It's definitely my pleasure to be here, and something that I think you and I have known each other a couple of years, and it's something we've always talked about whenever we've gotten together at the various gatherings that we've been to, in some of our experience. So, risk tolerance is probably the most misunderstood portion of investing. I think our industry has done a really poor job of both educating the clients on the risks they're taking, as well as properly determining what their true risk tolerance is. When I started with SEM 20 years ago, I laugh now because SEC required advisors to ask, what's your time horizon, what's your objective, and what's your risk tolerance? And, the answers for the latter were low, medium, or high. And, to this day, I see some advisors and broker-dealers only allowing those types of answers when they ask investors about their risk tolerance. So this topic is something that I found in my 20 years managing money to be by far the most important area advisors need to cover in order to ensure long-term financial success. My passion's always been helping educating advisors, and especially how they can better serve the needs of their clients, which is why I was so happy when Mike asked me to host this webinar. Our company, if you caught it there at the beginning, SEM stands for Scientifically Engineered Models. So as you might have guessed, we prefer science over art. But unfortunately, when you look at risk tolerance and really all aspects of investing, there's a blend of both. And what we've learned is if you incorrectly implement the art portion of our discipline, that can lead to some very undesirable results. At SEM, we're constantly trying to figure out ways to use as much science as possible to mitigate the risks of that art going wrong. And I believe over the last 20 years, we've come up with a method that, although it's not perfect, it's definitely close enough for most situations. So let's start with the easy part. The science, which is on the risk tolerance part, is something that I've always called it the ability to take risk. I've seen other people describe it as the capacity to take risk. It's all the same, and it's all the things that I believe everybody in our industry understands. If you first start with time horizon, short versus long. Then you jump to net worth. If you have a really small net worth, you may not have much ability to take risk because that's all the money you have. Income stability. If it's your income's going up and down a lot, then you really don't have the much room to take risk. If you have a very stable income, you have a higher ability to take risk. The income needs. Is there a high demand on this portfolio for income or low? And then finally, your return needs. Obviously, if you need higher returns, we're going to have to figure out a way to take more risk. And that's something that, like I said, I think everybody in our industry understands. To me, this is just financial planning 101, and something that I think every investment advisor is doing. If not, they should be having a formal plan to do that, to systematize it, and things like that. But we'll talk a little bit more about that in the end. Now the hard part, though, what we found over the years is the willingness question really comes down to, well, how do you feel about risk right now? And unfortunately, studies have shown that willingness seems to track the activity of the market far too closely. This is the slide I have up there has the actual feelings that psychologists have identified based on what the market's been going through. Obviously, we don't have an exact indicator that says, oh, today we are delusional, therefore we have a little bit more time. But in general, this is what we've seen risk tolerance tracking. And, let's face it, our clients are human, but so are we. And so as investment advisors, we can't use that as an excuse. As a fiduciary advisor, whatever happens, obviously the DOL rule is gone, but now we have the SEC stepping in behind them. We're fiduciary advisors. If you're working with clients and calling yourself an advisor, you're a fiduciary to some degree or another. It's our job to eliminate the human nature side of things as much as possible. So we have to be really careful to not fall into the same traps as our clients, especially as we get near the end of this market cycle. Now, our last webinar, we spent really the entire time talking about behavioral biases, so I won't go into all the details today. But just a quick overview to look at what's happening right now in the market. You can see things on there that I put some of the biases that we see happening, and over the course of a bull market, the natural tendencies take over. You look at what's been going on there, and in particular, something Rick and I have talked about for 20 years now is what we identified as recency bias. It's the psychological term is availability bias, and essentially your brain recalls what's happened most recently. It's easiest to recall. So if the market dips 5% and then it rallies, your recent experience is, hey, I should buy the dip. And so that's some of the things we see happening. But unfortunately for investors, the tricks that our brains play on us during that bull market always comes back to bite us when the decline starts. And too often people during the past market drop believe it was predictable. That's hindsight bias, which then leads to overconfidence in their ability to predict the next one. That leads to some greed entering into the fold, losing self-control, as well as the herding biases that we see during regret aversion. And what we've learned in our experience is the longer that bull market goes on, the fewer people will actually seek the help of a professional financial advisor. And during these bull markets, you see the do-it-yourself investing championed. I mean, I think most of us have been around a while. Remember those day trading rooms that were going up across the country back in the late 1990s. And the way I think of it is, somebody who wants to push the maintenance on their car, you might save some money doing so, but you should be getting help with that. And the second you feel a vibration or here's a rattling, you panic, and the first thing you do is you're calling your mechanic and you're trying to make an appointment to get that fixed. So, as a side note on that, it's my very strong, educated opinion that this push we're seeing towards passive investing and the robo-advisors is simply a bull market phenomenon. And it's similar to that online trading push that we saw in the late 1990s, where all these do-it-yourselfers were coming on board. And I do believe that during the next bear market, we're going to see some, basically the concerns I have on robo-advisors, but that's something for another seminar, as well as things we can be doing as advisors to fight this robo craze, because there are things we should be doing. But moving on, how do you determine willingness to take risk? And I've seen so many different methods over the years. One of my favorite things to do is traveling around the country with and visiting our different investment advisors and just seeing how they do this with clients. And there's lots of different ways, and I don't think there's a perfect way, but a lot of times we get too complex with things. And I think the best method I've seen is one of our advisors here in our offices in Virginia just came up with a simple way to illustrate this. And all the advisors in the office have poker chips to illustrate different things, but I saw him do this with a stack of poker chips, and he said, let's have every chip represent $10,000, and he built up the size of their portfolio, and he said, okay, we're going to start going through some situations, and I want to know at what point you're getting uncomfortable so much so that you're going to call and say, hey, I need to make an appointment to talk about this. And so he was walking through, and he'd say, he takes off $10,000, and he looks at both of them, and they're fine. Then he takes off another another 10,000, so they're at 20. And all of a sudden, the wife sits up and is kind of looking, and she looks at her husband, and so there you have the first clue. Okay, in this situation, the wife was a little bit more risk averse than the husband. And the second he reached for 30 and started moving it, the husband said, "Okay, I'm calling you." Well, right there, you just found out that, depending on the size of the portfolio, a $30,000 loss was the risk tolerance, and then you switch that into percentages, and there you have it. You have a number. And in that situation, it was funny because the wife said, if you didn't call him, I would have been called him anyway. So it's a fun thing to do because it gets the conversation going. And one thing I've seen other advisors do is what's critical is losing a number is one thing. And you might say right now, because every dip should have been bought over the last 10 years, hey, I can handle a $40,000 loss. However, when you combine that with what's always going to be negative news headlines during a bear market, oh, unemployment just hit a 5-year high, and personal income dropped to 10 years ago levels. Whatever those headlines are, it's going to be really bad. And when you combine dollar losses with negative headlines, that's when our psychology really starts to play on us, and those biases start to get in. And the reason I care so much about this is because when a client gets uncomfortable, they are likely to make an emotional decision, and that could cause them to not stick to their investments. Here you did all this work to do the financial plan and to set up the investment portfolio. If then all of a sudden you have them getting uncomfortable and not sticking with it, that destroys the whole plan. So, that's something that I think we need to do a better job, is really drilling down into what is that true risk tolerance. Now, I'm going to jump ahead just a bit on our agenda, where we talk about some of the tools out there, because I know, thanks to a combination of some really neat technology as well as a huge marketing push, a lot of people use Riskalyze. In fact, that's by far the most common tool that I see our advisors using. And I just wanted to give you my experiences with that and how I think if you're using Riskalyze, I believe you need to tweak it, because if it can be used incorrectly, just like any tool out there. So the number one question you start with when you're doing the Riskalyze survey is with the client is, what is the dollar amount of a devastating loss? And for some people, if they have $2 million, they might say, well, geez, if I lost $1.5 million, I'd be devastated. Where somebody else might think if I lost $200,000, I'd be devastated. So the definition of devastated is so vague, and it's going to vary from situation to situation. And then what I found is the answer to that question is going to put you in a small bracket where whatever the client answers on the Riskalyze score, they're not going to be able to get outside of that bracket. So it becomes the most important determination of what their risk-aligned score is. And it really doesn't matter what they do the rest of the time. So I switch. When I ask them devastating, I throw that out and I say, what's the level of loss where you're going to get uncomfortable? And then I do a similar situation, whether it's with poker chips or just an illustration of going through some loss scenarios, because now we know psychologically when the emotions are going to start triggering for that client. And that becomes very critical in the whole thing, because right now, I don't know if Riskalyze provides this data, but I know when I do Riskalyze scores without helping the client along on that, I've seen them all skew higher, and that's because we're 10 years into this bull market. But if I start with the uncomfortable loss level, then I get a much better reading on their risk personality and things like that. So speaking of risk personalities, this is something that really you only can do with the client. Some tools will try to do it better than others, and we'll talk about some of those at the end. But what I found out works well is just getting to know your client and kind of using where they're at as a guide. Now, we covered this a whole bunch. This was the topic of our last webinar. I put the direct link at the bottom of this slide if you want to write it down and listen to that, or if you just want a refresher, it's there as well. And as a side note, if you've found a way to screen out a client's risk personality that's working really good in your practice, let's get a discussion going on the fan board. Send me an email, send Mike an email, because I'm all ears. I'm always looking for new tools. So if you have something, great. But at SEM, one of the things that we've always tried to do is let's get close enough. And what we found is typically the type of client they are tends to dictate their risk personality as well. So if they're the conservative type where they're taking income and they're already retired and they have a low risk tolerance, they're going to have more of an emotional bias type thing. And same way, what I found is the aggressive clients tend to also be more emotional. So those are the ones where your communication with them and your education on what you're doing in their portfolios is extremely important. So like I said, I'm not going to spend a lot of time on that, but that is kind of a third dimension to the risk tolerance questionnaire. Is you have your willingness, your ability or capacity, then you have your willingness, but then it needs to factor into the risk personality, and that's where you really play a critical role as an advisor. And again, something a robo-advisor is not going to be able to do. So why is this so important? And even going back to 1998 when I first joined SCM, my partner Rick Gage told me clients' emotions swing the markets, and or swing with the markets. And so then he pulls out the Dalbar study and he showed me the numbers to back it up. And for those of you unaware, Dalbar basically looks at the investor inflows and outflows into stocks and mutual funds, and then compares basically a weighted average based on cash flow of how those investors did. And regardless of the 20-year look-back period, whether it was 1998, 2008, 2017, they've always had a 2 to sometimes 4% behavioral gap on the stock side. And then what's even just fascinating to me is on the bond side how little bond investors have made with that. And it's just something, that's what the data says. And the reason is if you look at the next chart, now this is a very noisy chart, but it's from Ned Davis Research, and it's an overlay of the S&P 500, which is the blue line, and then the inflows and outflows into stocks or into S&P 500, stock mutual funds and ETFs. So basically what's going into the stock market and what's coming out from investors. And one of the things that really point out is you see the big spikes up just before a market decline, and then as the market declines, you see a big spike down. So investors are basically buying high and selling low, just like that last slide showed us. The reason they're underperforming is they don't jump into stocks until well after the gains have started, and then they write them down, and then they jump out and they go over to bonds. and then they get really bad returns in bonds, and then they jump back to stocks. And so this buying high and selling low has gone on and on and on for really as long as they've done investing. And so you would think with all this education that clients would know better, and investors would say, nope, I'm just going to stick to my plan, but they don't because they're human. And that's so critical for us to, one, don't make them feel bad, but two, understand we got to combat our human emotions. And the numbers don't lie. If you look at these bands at above 20 and below minus 20 as far as Ned Davis measures the inflows, when the market's been above 20, the annualized returns over the next year have been negative 18%. So all those people that jumped in at those bands above 20 lost 18% of their investment. And then if you look down at the bottom bracket there, the below 20, that's the time to be buying. But that's when everybody floods out of the market. We've seen annualized returns at 36%, going back to 1997, which is when they start keeping the data. And even looking at the last 5 years where the market's done nothing but go up, we can see a big push, which is that last table there on the bottom right, of when it gets above 20, people lost 6.6%. And we've seen a lot of push into the market lately. And one thing that really jumps out to me is that big spike, that big red spike in January. And that was after the S&P 500 went up 7% in 3 weeks to start out the 2018. And, I don't know what's going to happen, until we have the benefit of hindsight. If this big last push was the final push in, or if we're going to see an even bigger spike up. But I do know our study of human nature and behavioral biases tells us, look, this is what people do with their money. And I've always used the joke, going back to the time of Moses, if you read the Bible, is they could be in slavery for 40 years, and they get out and they wander in the desert for a couple of weeks, and they start complaining and saying, slavery wasn't too bad. At least we had food. And that's just human nature, is we react to what's happening recently, despite, in their cases, seeing miracles from God and not being able to stick with the faith there. So I don't know why we would expect investors to stick with the market if the Israelites couldn't stick to Moses for more than a couple weeks. But anyways, I digress. Looking at psychological studies and why this really matters is scientists have shown that the chemical reactions our bodies experience are twice as high when we go through a loss than when we experience gains. And that could be, in your personal life, that can be financially, that can just be some other physical thing that you gain versus losing. And so, in other words, gains might feel nice, but the pain of a loss completely removes the joy and then some. So the more time somebody goes through this loss, the more it's going to impair their ability to make rational decisions in the future. And, I've seen in my 20 years, this holds true for both advisors and their clients. And I've seen advisors who got so burned at what happened to their business in 2008, they went completely the other way and reacted emotionally. And now I've seen those same advisors now wanting to swing back in to say, what, I'm just going to buy and hold, and I'm going to do that because I'll just tell the clients, hey, you might lose half your money at some point, but at least I don't have to deal with clients complaining. And so it just weighs on you. It's human nature to do that. But it's our job as advisors to, again, educate ourselves and then fight through it. And one of the things that, as a complete side note, both Vanguard and Russell have highlighted the value that you play as an advisor. And I put the link to the actual studies that Vanguard and Russell did. We actually created a whole brochure based around this that we give to every prospective client. We send it to our own clients once a year. It's something that they need to be reminded as to what the role we play is. And I talked about it quite a bit on our last webinar. I'd encourage you to go to that page there and download the PDF of those studies as well. And again, we'll talk more about this in future webinars. But let's move on to the hardest part of this whole thing, is you know the risk tolerance. Now, what do you do with the money? And traditionally, we've been told you'd allocate assets. I kind of did some simple asset classes there of the bonds down to mid cap, small cap, and international stocks based on the time horizon and the risk you want to take. And then over the last 10 to 15 years, we've seen a lot of these asset allocation type portfolios come up that'll automatically do it, especially the target date funds are kind of this concept as well. And so in general, the theory here is the diversification will help you lower the risk in the portfolio. So all you as the advisor have to do is put the client in the right one and everything's fine. And here's what the logic is behind it. And the problem I've always had with modern portfolio theory and trying to calculate what should go in a portfolio has been, first of all, how risk is calculated and communicated. And so this chart here from Morningstar has the returns up there on the vertical axis and the standard deviation, which is the most common measure of risk. There, I think most of us as advisors understand what standard deviation is. I think very few of us can communicate it clearly to a client besides to say, well, it's how volatile things have been. And it's, I don't know why our industry is stuck with this antiquated measurement of risk, because it means nothing to the client or most investment advisors. Maybe it's because they could say, we'll classify this as low, medium, or high risk, and leave it at that. We're not locked into any sort of actual loss number. Maybe it's CYA. I don't know. But it just doesn't do anybody much good to say, well, this is a standard deviation of 12, or it's a moderate risk, because that means nothing to us and it doesn't help us get to the right portfolio. And there's formulas out there that you can use to turn standard deviation into an actual loss number, but nobody's really doing it that I've seen. And if you look at this chart, we see, modern portfolio mostly, does its work. The open shapes there are the asset allocation portfolios that we talked about, and then the closed ones are the individual asset classes. So the modern portfolio theory says the more return you seek, the more risk you're going to be taking. And just for reference, that cross in the middle is where the S&P 500 is. And if you jump ahead, here's the same chart, but we're using the target date funds. And so sharp eyes will notice that these portfolios are actually a little bit more efficient than those Morningstar asset allocation portfolios, which I thought was interesting. But either way, it's the same relationship. You want more return, you have to take more risk, but nobody's really telling you what standard deviation actually means in terms of how much risk there is. But that's what we do here at SEM, is we provide the data. So here's those same Morningstar allocation portfolios and the actual drawdowns that they've had historically. So again, another noisy chart, lots of lines on there. But I think you can kind of see the problem as a general direction. You could see the first bear market in 2000 through 2002. Almost all the portfolios lost money. But then you jump to 2008, and now they all lost money, and they even more than they did the last time. And then 2011, they all lost money. And so now a moderate risk portfolio, I don't know what that means. You look at these are all diversified portfolios, and even the preservation portfolio, which is the smallest loss there on the chart in 2008, it lost more than 20%. So if your clients answered low risk tolerance on your broker-dealer's questionnaire, they weren't ready for a 20% drop. And then what are they going to do? They're likely to fire you. They're likely to just go to a cash, go to a fixed investment, and really do themselves a disservice and disrupt the whole plan, because they had no idea that this was the type of loss they signed up for when they checked low risk tolerance. And that's because they weren't told by the standard deviation or whatever. So just remember, when people lose more than they're uncomfortable with, they're likely to make that emotional decision, and that's kind of the takeaway from here. If you want to look at the target date portfolios, it's the same concept. Here now we have the target income, so this is supposed to be for people in retirement, and you'll see it lost 15%. Actually, I think it's 17 point something or other in 2008. Um, clients need to understand this. This is very risky, and so imagine the situation of a client taking withdrawals and going through a 15 or 17% loss. So not only do they see their principal value going down because they're taking money out, they see the losses from the market, and then they have all the negative news headlines. And so again, that's where you could see people flip into something, a fixed instrument, and never get back in. We've seen it with moderate clients who, told us they're moderate. When we drill down, moderate for most people is 15 to 20%, which is, in the whole scheme of things, not a lot of risk, and obviously something that is very likely to happen in almost every asset allocation portfolio. It's something to be concerned about. Now, one of the services that we offer our advisors is a free portfolio review, and we simply take the client's existing portfolio from their statements. We put it into Morningstar, and then we provide a nice snapshot showing both their asset class exposure, so they can identify maybe where they're overweight or underweight certain asset classes, but more importantly, to turn that standard deviation into a risk number. What type of loss should you be expected? And recently, I guess maybe 6-7 months ago, the most memorable experience I've had when I've done this, I was able to present it in person when I was doing a meeting with another advisor, and I'll never forget the look on that client's face. We showed her this conservative portfolio. In fact, this is what blows me away. A lot of times when I do these illustrations, the broker-dealer statement will say, portfolio type, conservative. And that's what this client said. And or I've even seen one that, risk tolerance, low. And then I run it and it's like a 25% risk. Anyways, so this conservative portfolio had a downside risk of 35%. And she looked at me and this other advisor and she goes, why wouldn't Brian tell me this? Now, Brian was her longtime advisor. We weren't trying to capture Brian's assets. We just said, hey, we're trying to manage this portion of your portfolio. You told us you're very risk averse. We'd like to just take a look at this. And, I explained to her, look, it's not Brian's fault. It's just how we were all taught. We were told, hey, you focus on the returns over the risk. You tell them standard deviations. You put it in a low, medium, or high bracket. You don't quantify it. And I just think that's so wrong. And, my goal is to have you not be Brian, who found himself losing this longtime client just because he never told his client what type of risk she was facing in her portfolio. And, I just want you to do that before it's too late with a lot of your clients. So now that we know the true risk, number in a portfolio, I wanted to illustrate a different way to look at the efficient frontier. Now at SEM, we use a number we call modified value at risk to measure risk, which takes the standard deviation, applies some statistical tweaks, based on the distribution of returns, and then it assigns an annualized risk number. And so, generally this will plot somewhere near what I think is the second best risk measure, which is maximum drawdown, which is what I showed you on those Morningstar charts previously. And either way, maximum drawdown, modified value at risk, it gets you close enough when you're allocating clients. But there's some things I think this helps us illustrate when we switch standard deviation to actual risk numbers. Is, first, the inefficiencies of most asset allocation portfolios. I mean, these passive portfolios, the Morningstar ones, they're not very good. They're lagging what you could just do yourself in a do it yourself rebalance type portfolio. But then secondly, if you look at the target date funds, they do a little bit better, and I looked a little bit closely, and the difference is really what Vanguard is charging on their portfolios versus the gray dashed line, which is a no-fee passive portfolio. I'm not quite sure what's going on with that 2030 portfolio, but most likely a little bit more international exposure than we had modeled in our passive allocation there. But secondly, I think forgetting what's inside those portfolios is our experience over the last 20 years tells us that most people fall somewhere between that 5 to 25% true risk tolerance range, meaning pretty much every portfolio out there is going to exceed the risk comfort level at some point or another. And you know what just baffles me with our industry is if we've been taught to just tell the clients, hey, you're just going to have to deal with the risk if you want these types of returns. And you know, anybody that's had teenagers knows I have 4 grown children and 2 almost 12-year-old twins. So I've done this, and one thing we learned pretty quickly is if you try to dictate behavior, it's not a good way to get results. And we've seen that with clients over and over and over again, especially when you get the bear market, is if a client's uncomfortable and you tell them, look, it's something you just have to deal with, they're not going to be very happy. And you know that's the time where you risk losing the client. So I think that's something that you know it's we don't want to be in the business of doing is just saying, hey, just deal with the risk, because there are better answers out there. You know, as a side note, maybe sometimes we do need to coax people into taking more risk, and the best solution there that I found is the bucket strategy. I know a lot of you from my conversations in the fan group and such have you do the bucket strategy where you divide the money out into different things, and that gives us a better chance of making sure that if their short-term needs are taken care of, then they might stick to their longer-term money. But I've learned from experience is you got to educate them, and you got to constantly be communicating what the goals are for each portfolio, because people that are more risk averse, they will still see the $10,000 or $20,000 losses in their long-term money and still get concerned. So you got to constantly have a dialogue with clients regarding that. So, but anyways, back to I think the main point of this slide is the answer that we found at SEM is blending tactical, dynamic, and strategic type portfolios into single accounts for our clients. And what that does is tactical investing can take advantage of a lot of the inefficiencies we see in the fixed income market. And the reason most of these Morningstar portfolios underperform, and even some of the smaller target date funds, is because there's buying and holding in bonds is just not a very good thing to do over the long run, especially where we're at right now with interest rates and the bond market cycle. But you know, more importantly, it gives you that diversification of strategies and gives you ways to chop off the losses, and it makes it so the clients are more likely to stick to their plan. But it also gives them a good chance of outperforming over the long run. So that's something that I think is really important. And I'm pretty sure, looking at the list of people that signed up for this webinar and the people in Mike's fan group, most of you have access to these types of tools with your broker-dealer. A lot of you can go direct and do it yourself, and there's plenty of tools out there to let you do that. And others, you know, may have their own captive type portfolio. We're here to help. We work with a lot of these platforms. We also know pretty much all the managers out there, what they do well, and where you need to offset and diversify. And so definitely let me know. Just send me a message, and I can help you identify what you have on your platform and maybe help you guide you in the right direction of how you create your own blended portfolios like we show up on that chart. So finally, the last item on the agenda was looking at the more popular risk tolerance tech tools out there. And I put up this technology solutions map from Michael Kitces. He writes the Nerd's Eye View blog. If you're not checking that at least every weekend, you know, I think you're doing yourself a disservice. I don't know where Michael finds his time, but to do all that, I have a hard enough time writing a couple blogs a week. But you know, if you're like me and you're always wanting to have the latest and greatest tools available, you know, this map really shows you the frustration I've had. And the box in that top left corner is just the risk tolerance tools that are available, the most popular ones as determined by Michael's survey. And you know, I've looked at all of them at some point or other over the last 3 years, and I've talked to advisors that have used them. And you know, our goal at SEM's always been, let's come up with a way to systematize the entire process. Remember, we don't like art. We want everything to be science. And so we looked at these tools, and we were hoping to find the perfect solution, and unfortunately, none of those are the perfect solution. But I think depending on your practice and your client base, they can at least help you get closer to science and art when it comes to the risk tolerance. Some of our experiences, we touched on Riskalyze. They're well known. I know a lot of the common complaints are the number of clients you can have in there and how much it costs and things like that. But the main thing, if you're using Riskalyze, like I said, that devastating loss question needs to be converted over to uncomfortable loss. Financial DNA, the next one, is a psychological profiling tool, and I love it. I mean, goodness gracious, I thought this was the greatest thing that I've ever found until I started doing it with some of my clients, and they're like, Jeff, this is way too much. It's way too detailed. I don't really care. And so that's really the downside there. It also is a little bit pricey, but for higher net worth clients, it may be something they're willing to do. I mean, it's as much money as some of these people have, investing 25 or 30 minutes into helping you do a better job with their portfolio, I think is worth it. But I'm a nerd, and I like that kind of things. Phenometrica is very thorough. I love the portfolio comparison tool. Again, the biggest complaint that I've seen people have is the questionnaire is a little long. It's one of the longer ones that you'll have as far as just risk scoring. IPS Advisor Pro integrates with Phenometrica now, which I think is kind of neat. Gives you an investment policy statement that I think is way better than what Riskalyze generates. It's something that can also get very detailed and very expensive depending on how you're using it and what your practice is like. Data Points is intriguing, but like Financial DNA, it's very complicated and can be pricey, but it does seem to be a little more detailed as far as being a more comprehensive financial planning tool. So that's something that you might want to take into consideration. If you really like getting into the nitty-gritty of behavioral biases, Data Points might be one that you want to take a look at. Risk Pro, goodness, it's it is so detailed and sophisticated, but every advisor I've talked to that started the trial ended up migrating away. But it's definitely intriguing, both as far as doing proposals and ongoing support, and one that I think will probably get a second look from SEM. And then finally, the last one that I wanted to highlight there is Tolerisk. And what I really love about Tolerisk is it's the first one that I saw that's simple and looks at both the willingness and ability to take risk. And what I love about the way Tolerisk does it different than Riskalyze is it's not so much how do you feel about risk today, it's what is your risk profile, your personality, if you will, versus a one-time snapshot. It tends to be much more consistent than we found with people using Riskalyze. It's also because it does incorporate the ability questions. It's a very good light financial planning software. Now, it's not going to get into things like long-term care and Social Security strategies and things like that, like some of the more popular financial planning tools will. But I mean, honestly, how many clients really need that deep financial planning versus just to be able to say, here's my portfolio, here's my income needs, here's my other sources of income. Am I going to run out of money? And a nice, clear, concise report, and that's something that Tolerisk does. That can be used in a lot of cases, at least as a starting point. It is something that I forgot to mention when we did the invite with Mike. We do have a discount code for Tolerisk. We get paid nothing from it. We get paid nothing from any of these providers, and we use several of them with our clients. But I just like to be out there educating people on the tools that are available, because as you can see from that map from Michael, it's very daunting to go through all of these tools. But like I said, find something that works for you. If you have questions, you want to run something by me, I'd love to be able to just hop on a call and go over what you're seeing and how you might apply that to your portfolio. So definitely reach out to me on that. So I always like to close our sessions with a few takeaways. And our goal is to help you be more successful. And one of the things that I think you can gain from this is you got to systematize your ability calculations. You got to do that financial planning in a way that you have the same process where your pre-meeting is the same, and then your first meeting is the same, and getting that going just helps you become more efficient, and then also allows you to scale that and provide consistent service to your clients. Secondly, discussing the true risk willingness by using dollars and situations rather than a general category of low, medium, or high. I keep hearing people say, well, they're moderate risk. Well, what does that mean? Switch it to dollars, switch it to situations of how are you going to feel if this comes during a recession and you lost $30,000. Find that true risk willingness. And then develop efficient portfolios designed to meet both areas of the risk tolerance. And that's the important thing is some people do need higher returns, but if they're only willing to take 10% risk, there's some education that has to go along, and then that goes back to your financial planning section. And this isn't a financial planning webinar, but one of the biggest impacts you can see, which by the way is one of the things I love about taller risk, is it can run a scenario analysis to show you the biggest areas a client needs to focus on, and I'd say 7 out of 10 times it's the spending during retirement that's the issue, not the growth of the portfolio, not how much they're saving in their working years, it's how much they're spending. So if they're unwilling to take the risk that they need to get the returns that are necessary to meet their goals, circle back up to that financial planning and see what else you can do. Or see if you can do the bucket strategy like we talked about to spread out what they're doing. And what we found with our advisors across the country is you get educated clients, you put them in efficient portfolios, and you'll have solid growth, especially during a bear market. Goodness, if you were out in front of your clients and telling them about the risks they had in their portfolios and how you're trying to keep them from doing something that they won't be comfortable with, the referrals just grow like crazy. But then the stability of your practice, if you told clients and you're going to lose 25% and they understand the dollar amount that's going to be, and you keep that education process, you're not going to see what we typically see, which is clients going to the exits, moving to something really low risk, and then missing out on the benefits of being in there on the upside. So, for those of you that want to hear more, we have quite a few resources at semwealth.com, especially our blog where I post weekly insights as the bear market hits, whenever that might be. I definitely will go to more frequent posts. During 2008, I think I was for sure writing once a day. There were several weeks where I would do 2 to 3 posts a day just because the market was moving so fast. Everything we put on there is meant to be data-driven. This is what we're seeing, trying to help remove the noise that you might hear on Bloomberg or CNBC. And we'll always post any client presentations on the site as well under the multimedia section. Most importantly, there's no sign-ups required. Check in there as often as you want. So I truly want to thank you for joining us, and I'm going to turn it back over to Mike to close it out.
Hi, great. Thank you so much, Jeff. That was fantastic. I love using an Old Testament reference to talk about overcoming an old, very old problem for individuals. So on that, are there any questions, Jeff, that anybody has written in?
No, the main questions were, how can I get a portfolio review? And then the second one was, what's the discount code? We're going to be sending out as soon as this recording is available, a message for you to sign up for the replay, but included in there will be you requesting both the portfolio review for any of your clients as well as the taller risk discount code. Great.
And that also applies to those who are watching this who couldn't make the live event but are watching the video.
Absolutely.
So, well, thank you again, Jeff, and thank you, everyone, for attending this. My fan members, I hope you enjoyed it. If you did, please let me know, because this way we can provide more help like this. Thank you.